Hey there, everyone. Dave Keller here with StockCharts.com. Welcome to this special all mailbag edition of the Final Bar. I hope you guys are doing well. And let's get to a series of questions we received in our Final Bar mailbag. As a reminder, our mailbag is always open, so you can email us your questions at thefinalbar@stockcharts.com. Of course, you can just tag us in a comment on Twitter or X at FinalBarSCTV as our handle there. And on our YouTube channel, of course, just drop a comment below any video that you're watching. We'll gather all of those questions. We'll hope to answer one of yours in our next mailbag segment, which will be one of our shows next week. Let's get to question number one. Do you agree that Tesla is headed to the 200-day moving average within the next week or two? I love the directness of your question, by the way, and thanks so much for asking that. No, so I would not agree that anything is happening, and I think that maybe the phrasing of your question is implying a certainty that I don't think you can assign to charts. You have to remember, Carl Swendlund, who's a longtime StockCharts contributor, always says that technical analysis is a windsock, not a crystal ball. So we don't know for sure where Tesla is going to go next in the next minute, in the next hour, in the next year. The best we can do is use the best practices of technical analysis to assign probabilities. And what we usually mean when we're showing charts and identifying particular buy or sell signals is that the most probable outcome is to follow that signal. But you always have to think about sort of that alternate hypothesis, right? What would tell you that that signal is no longer in play and that something different may be happening. So generally, what are the observations about Tesla here? I would describe Tesla as more in a consolidation phase than anything. So it's hard for me to say I think Tesla's heading to the 200-day because I don't think the chart is giving you a clear indication in either direction. What you have to think about is a chart like Tesla can go up, like it was from early 2023 really through July. It can go down like it was from September to December of last year, or it can go sideways, which I would argue what we've been doing from June through September. If you look at where we're at right now, we're pretty much at the same exact level that we were 3 months ago, right? And we've overshot and undershot that value right around $250. But overall, we just keep rotating around there. Note this pattern of lower highs and higher lows. That's what we call a consolidation pattern, a coil pattern, maybe a symmetrical triangle. And the general way that you draw a pattern like this is basically connect the highs. So we can do that, connect the lows like this. And basically at some point, either we break above the upper boundary or break below the lower boundary. I would argue that this higher range, sort of between, we'll call it 300 on the upper end, and we'll call it about 215, maybe 210 on the lower end. That's your framework, right? That's the high from July and the low from August. Until we break out of this range to the upside or the downside, I think it's wait and see mode. Now, the fact that we've rotated lower, does that mean we're going to get to the 200-day? Not necessarily. And I would say we now have kind of a range within a range. You can see in the short term, we have a shorter term high and a shorter term low to assign. So overall, consolidation patterns like this really don't imply a general direction. You have to wait for the pattern to break. So these green lines may be the most important to watch. Whichever way we break above the upper boundary or below the lower boundary, that would be the first real indication that a next target is in mind. So before we get to the 200-day, we have to break down through trendline support. We haven't done that yet, but that's what I would be looking for on the chart of Tesla. Let's get to question number two. Dave, is it possible to have a relative strength graph that is normalized by beta or some other measure of volatility? It's a really good question. The short answer is no. I'm sure someone has come up with something, but not anything that's really part of the real toolkit of the technical analyst. I'm trying to think of like a volatility adjusted relative strength. Not really. And I guess I'll tell you why. I mean, relative strength, that's what I'm showing at the bottom here. And most people measure relative strength very simplistically. It's simply a ratio of the stock divided by the other benchmark or whatever the denominator is going to be. And most people use like the S&P if you're a US-based investor. I've seen, if you're more of a financial advisor, if you're managing retirement accounts, a lot of times I've seen people do relative strength to like a balanced benchmark, like a 60-40 stock to bond, fund of some sort, just to sort of give you, you're trying to outperform that sort of general allocation. but nothing where those levels are adjusted based on volatility. And I guess the way to think about it is, I'm doing it on a percentage basis, which is a little misleading, to be honest with you, because what this is showing you is the percent change in the ratio from the left side of the chart to the right side of the chart. It doesn't actually mean that Tesla's underperformed by 6.7%. It's going to be close to that, but it's not exactly that, because you're not looking at the return on Tesla minus the return on the S&P over the period, which is what you would need to do to have that value mean something. So most people actually just do it in a very simple way and just take a ratio of the one versus the other. So this is simply the value of Tesla over the value of the SPY. The value is currently 0.57, but the value is meaningless. It has no particular meaning. The direction is what's important. And if you think about it, on a series of charts, the relative strength line is always going to expand to meet the volatility of the instrument. So a very low volatility instrument, the relative strength line, is still going to kind of look like this, because it just moves a lot less. So the range is a lot lower, so it actually spreads the indicator out. On a super noisy name like an emerging technology name, or like a biotech stock, something that's more higher beta, higher volatility, the relative strength line is going to have a much wider range, but it's still going to fit to the panel. So if you look at ratios like this, it kind of automatically adjusts visually to the data over time. And that's one of those phenomena about technical indicators. Connie Brown often talks about the range of technical indicators and what they mean, and to be a little more flexible with settings. I know at the Fidelity Chart Room we actually did. Now that I'm saying this, we actually did that. We did a volatility adjusted. I finally got there. It took me 3 minutes of answering your question to remember we did this. We actually would do a volatility adjusted relative strength ratio, and it's the only time I've ever seen anyone do it. And it was featured in the Fidelity chart. I don't know if it's still in there, but we would take the largest U.S. stocks and chart them on a consistent semi-log scale is the way to do it. And it wasn't just the relative strength. There was more of the price action as well. So we would use a consistent y-axis across like 100 charts. And what happens is basically the chart of a technology stock would be like off the page because it would be so noisy. And the chart of Walmart would take up like a quarter of and there'd be a bunch of white space above and below because it was adjusting it for the volatility. We did that so that you could look at a ton of charts and actually see on an apples to apples basis, maybe visually compare the volatility characteristics. That's super unusual, and it was the only place I've ever heard of anyone doing like that. So not that I've heard of, to be honest with you. Is that an area of future development for relative strength? Yeah, maybe. Something to think about. If you think about it, the RRG, by the way, the relative rotation graph, does adjust a little bit for not as much for volatility, to be honest with you, although it is kind of in the calculation. It's implied there, but it's not a direct adjustment. I'm just stream of consciousness. That question made me think. Thanks for that. So the short answer is, yeah, it's probably possible. Have I seen it done very often? No. And it is a part of the normal technical analysis toolkit. No, but something that's on my rainy day list now. So thanks so much for that. Next question. What do you think of Wing now that it is back above the 200-day moving average? I think wings sound amazing for dinner, although that's not what I think we're having. But Wingstop, WING, is a sort of fast food wing outlet around the U.S. And if you look, pretty good run from May of last year. So if you think about how the major averages bottomed out in October, Wingstop actually bottomed out a lot earlier in May and outperformed beautifully in the summer months because the market was still going down and this stock was actually going higher. Nice continued uptrend into a May peak, but then it peaked early. So it bottomed early and then peaked early. So it's coming down. You can see the relative strength was pretty weak there. Want to kind of look, before I answer your question directly, kind of look at this one to just see what sort of levels we got to. You see we pulled back to a 38.2% retracement level, eventually went lower almost to the 50% level, but stayed above there and then moved higher. So, and back above the 200-day, back above the 38.2% level. So what do I think of Wing? I mean, overall, in the short term, it's going higher, and I think that's encouraging. Things that I would look at on a chart like this just to make that assessment. Number one, taking a trend line. Anytime you have something going down like this, a simple trend line using the major highs can be just a helpful visual cue. While I don't think this is a great trading system necessarily, just tracking the fact that we had a peak, we had secondary peaks in June and July, and a trend line connects pretty well to this period here where we pulled back and then finally broke above that. I think that's encouraging. The fact that the stock's back above the 200-day moving average, I think is encouraging as well. The fact that the relative strength is improving in September is good. The RSI has gone above 60 on this most recent rally. When in a downtrend, the RSI rarely gets above 60. In a bullish phase, the RSI often gets above 60 because you have those big accumulation days that push the price higher, push that momentum indicator higher. So overall, I think this is a stock that had been in a decline from May through early September. While the markets are pulling back in September, this has actually turned very nicely and gone back to the upside. I think that's a good chart. In terms of upside potential, logical next step would be 200, big round number, and the resistance from June. That's probably where I would be looking on Wingstop. Good chart, and showing some characteristics of a nice reversal, which I think is encouraging. Next question: could you go over the technical setup of one of your past trades? Really thoughtful question. I have to do this quickly only because in a mailbag show, we don't have that much time for each question, but let me get one. Let me get something set up here. So I actually do a presentation sometimes where I talk about my technical analysis checklist, and I'll just show you briefly. This is an example that I like to show, and this is from 2019. Again, I'm very careful. Most of my career was spent with at large firms where I had a compliance department that really prevented me from talking about or thinking about a lot of things, so as to not, have any sort of issue about what we were doing as a firm and what I was talking about on the particular charts. I don't have that issue now, but I don't do a lot of trading on individual stocks as a result of that. Most of my portfolio is ETFs and thematic investing and a little more longer term. But this is one of the setups that I thought was pretty constructive here in 2019. And this checklist hopefully explains why. Probably the chart of Wingstop, probably had a lot of similarities to what you see here. I think of a checklist in 7 steps, and I'll go quickly through the 7. It starts with trend. Is this chart going upwards or downwards? An Alphabet in March of 2019 going up, and I can say that with confidence. It's not an opinion. That is a factual assessment of the chart because I'm looking at the highs and the lows. Higher highs and higher lows are an uptrend. This is an uptrend. Where are we at relative to key moving averages? Well, we broke above the 200-day moving average. We're now above 2 upward sloping moving averages. Ideally, the 50 would be above the 200-day, but overall, I think this is constructive at this point. Any price patterns? Well, I'm noticing like a bit of a coil pattern here. We had the rally off of the December low, lower highs, higher lows, and a break out of that pattern, that little trend line. We sort of break above there as the get above the 200-day as well, so I think that's encouraging. Support and resistance. We've eclipsed previous support levels here. I would also note we just got above the Fibonacci resistance, the 61.8% level. So I would say the next day, I'd love to see follow through. I'd love to see an additional confirmation that that's happening. But the higher lows are pretty helpful. I also didn't mention the trend line, but a trend line from the December and February lows, number of retests, retested again here earlier and now rotating to the upside. Confirmation is what I basically label any indicators like MACD, PPO, RSI, DMI, any of those kind of things. The relative strength index, the RSI, is strong but not excessive. It's above 60 on upswings. It's not getting below 40 on pullbacks again, which just confirms we're in a bullish phase. So I think that's a thumbs up as well. In terms of relative strength, just starting to improve. I'd love to see the relative strength break out a little bit more, but overall, I don't see a lot to not like on that particular setup. And then the last one would be an exit strategy. Let's say I do go long today at 1179. What would be my exit strategy? For me, the most recent low is usually a really good starting point. So I'd probably do a bit of a deeper assessment, but as long as we hold the 200-day and hold that previous low right around 1130, I would think that's a pretty decent setup with further upside potential. We break that, I'd have to reassess and maybe retime the entry point. That's an example, again, from a couple of years ago. But what I find is, as a technical analyst, you find a setup, you find a combination that works. So this is the checklist that I use. And then I just look for this combination. I look for charts that satisfy, that give me checks on all 7 of these. And it's not always all 7, but most of them would probably be enough for me to want to take a position. So there's an example using Alphabet from a couple years ago. But again, I apply that checklist often, and that's what I'm looking for. Great question, by the way. Next one, how would you set up a chart for intraday trading? We are going all over with this mailbag, which is super fun. How would I set up a chart? Well, this is one of the charts that I have up. And, full disclaimer, I'm not a day trader, and that's not what I hope you never pick that sort of thing up from me. I think there's a lot of shows on YouTube that focus on day trading, focus on super short-term timeframes. I think that's a noisy time frame to operate on, to be honest with you. And for me, I focused on at times more of a swing trading time frame, which is like a couple days to a couple weeks. And I still do that to some degree on tactical mean reversion, right? And sometimes I'll use short leveraged ETFs to bet on a quick reversal in some of the major ETFs. But overall, I'm more medium term to longer term. I'm thinking more months down the road in general in my positioning and how I do my own investing. Having said that, what chart would I use to get a read on the intraday time frame? So a couple different ones, and I guess it depends on what kind of questions you're trying to answer. Two charts that I look at on an intraday time frame with some regularity would be an hourly chart, and that's just if the daily chart, if I'm really getting into something and I'm really trying to understand the dynamics, sometimes the hourly chart can give you just a little more granularity about the trends and how they're reversing, particularly at an inflection point. Because what you have to remember is if there's a big downtrend that starts going up, right, the downtrend is over, the weekly and monthly charts, it takes quite a bit for them to pick up on the fact that the trend is reversing. Daily charts and even hourly charts, intraday charts, that's where you'll first see the reversal. The opposite, or I guess the problem with that is a lot of times you can get whipsawed, right? So you can see a pattern on the daily or on the hourly chart that never really creates a change in trend on a longer time frame. So you have to be a little bit careful, but I'm always looking at daily and shorter time frames just to see the short-term dynamics, how it fits into the bigger picture that I really am trying to focus on. So, a 5-minute chart is probably the lowest I would go to. Back in my, earlier in my career when I worked with a lot of hedge funds, we do a lot of 1-minute charts and we would try to pick out turning points. That is in the rearview mirror of my career at this point. So I don't pay as much attention to the 1-minute time frame as much. It's pretty noisy, to be honest with you. 5 minutes is pretty good for me. And what I find, the 5-minute chart with the MACD and the RSI is a really good combination. What I found is the MACD or the PPO indicator in particular, usually on a 5-minute chart only gives you like 2 or 3 signals a day. So if you look at just today on the chart of Wingstop, I just had this up randomly. We kind of opened here around 180. We traded lower to around 178. You can see there was a buy signal right after 10 a.m. Eastern, which told you the chart was going higher. It's going higher, higher, higher. Starts to roll over. You can see the sell signal here right around the lunchtime hour telling you we're in a downtrend. And then one more buy signal here around 3 p.m. I'm kind of okay with an indicator that tells me sell, buy, like that's not bad, and that's about as specific as I would need to be about short-term time frames. So if I'm trying to just think about short-term swings, I look at a 5-minute chart. I use MACD and I use RSI as well, particularly for like divergences and when things become overbought and then come out. A lot of times that can be an indication of an overheated market, particularly right out of the open, and then you have that initial rally and then things cool off. The RSI being overbought and then coming out can be often a really good indication of that. So that's what I would use if I'm trying to get a read on that time frame. Hourly charts as well. It's sort of in the middle between a daily view looking out at 6 to 12 months, if not a little bit more, and a 5-minute chart. We're just looking at the last week at most. That hourly time frame is kind of right in the middle. Sometimes that's where you need to focus. Good question. Next question, what are your thoughts on BABA? So Alibaba, I would say I'm going to ignore sort of the broader implications of China, macroeconomic implications, the dollar. I mean, these are not things that I think you think about or should think about when you're doing a technical analysis of the stock. But I would say if I was going to pull the trigger on something like Alibaba, I would do a lot more due diligence or a lot more awareness of China versus U.S., all the geopolitical challenges, the economic data we'd be getting from China, which overall has been, pretty challenged here in 2023. The strength of the dollar and what that means for a non-U.S. stock. That's not a particularly great setup for non-U.S. names at the moment. But assuming you do that separately, which I would encourage you to do, what can we learn about the chart of Alibaba? So this is one that had a run from the October low to a January peak and then has been kind of consolidating. So it really does have a very different look than a lot of the charts that we look at on the show. So what I immediately want to do is draw some Fibonacci relationships or some Fibonacci lines. And the reason why I would do Fibonacci lines here is because, let's see, that's pretty good. Because anytime you have a clear low and then a clear high, and then we go back within that range, Fibonacci analysis is meant to help you define that framework, right? I often talk about it as like a Fibonacci framework. Let's go back to like a year just to spread this out a little. So here's the low in October. Here's the high in January. Now we've come back in. So 38.2% is right around $97, 61.8% right around $82. And I just can't help but notice how many times we've bounced off of this Fibonacci support level. We're getting down to those levels again. So I think my first initial thought is to think a little more contrarian and say, I probably assume that there's some support here. So, taking a position down in this range, sort of the 80 to 82 range, and betting on another opportunity to find support, I don't have a problem with that. Making sure you have a well-defined exit strategy, a well-defined stop, just in case that doesn't work, I would say that's a really good idea. So what you think about is you've got some, an opportunity to get in here on the lower end of the range. What's the upside? Probably to the previous highs, probably to the Fibonacci resistance here, which has served pretty well. So 98 to 102, we'll call it, sort of comprises both of these highs. So we're kind of range bound between the lower end and the upper end. And in this sort of environment, you have three choices, broadly speaking, right? Number one, you bet on mean reversion and just play the swings, right? Which is what I guess I'm sort of implying here. Number two, you sit on your hands and wait for it to break, or use some sort of options to, basically assume, I think we're going to stay in this range. I just want to use a straddle or a protective put or something to kind of collect some premium or benefit from the stock staying in a similar place to where it is right now. The third option would be wait for a break and use a break above 102 or below 80 as your trigger. And my main thought is to be patient and wait for a breakout. I don't see a lot of opportunity in a sideways name like this, and I don't use a lot of options. If I did, I'd probably be thrilled about a chart like this where you could just bet on volatility remaining low and the stock remaining range bound. But my initial thought bringing up this chart is this is right sort of between the sweet spot of Fibonacci levels and support, Fibonacci level and resistance. I'd be inclined to bet on a short-term bounce back to the other side. But again, keeping a stop in mind, a break below 80 would sort of eliminate that as a good short-term play. Next question. Do you see a divergence between the US dollar and crude oil? I saw your question. I was bringing up this chart, and my short answer is no. I think maybe you sent this question thinking about this part here. So this is just so we're all on the same page. This is the dollar index on the top. The middle panel is crude oil prices. The bottom panel is gold. And if you look at this chart, you can see that from mid-July, the dollar's been trending higher. From mid-July, crude oil has been trending higher. From mid-July, gold has been flat and now breaking down through 1900, which I see is a pretty significant breakdown of key support. So do I see a divergence between the dollar and gold? 100% yes. Do I see a real divergence between the dollar and crude oil? No. Now, I have heard a lot of people that talk about relationships. When the dollar goes down, gold goes up. When crude oil goes down, the dollar goes up. And what you just have to, I can't stress this enough, those relationships, while we want them to be static, while we want them to be perfectly consistent, you have to remember they change a lot. And it often has a lot to do with inflation. If you go to John Murphy's books on intermarket analysis, read in particular when he talks about inflationary versus deflationary or disinflationary periods and how the relationships change in those different environments. There are times when the dollar and gold will move in the same direction. There's a time when all three of these may move in the same direction, and there are times when they move differently. And the reason is because it's not a zero-sum game. It's not like these two are just inverse of one another. There are a lot of different things. The dollar is relative to a basket of other currencies. Crude oil is quoted in dollars, but is, subject to supply and demand issues and all sorts of different things. So, there are a lot of different factors that drive these changes in these assets. The relationships are not as consistent as we usually want. We want them to be very simple and understandable. It's just life is not like that. Again, I would encourage you to go to John Murphy's book, particularly where he talks about inflationary versus deflationary periods, how that can change these intermarket relationships. But in short, to answer your question, no, I see the dollar strengthening for now, getting above 109, 107 would be pretty sort of that next step higher. And then overall crude oil, I think for now, continuing in an uptrend of higher highs and higher lows. Next question. Do you think ZM will ever recover? So the short answer is yes. I do think that Zoom will ever recover. Do I think it's happening right now? No, I don't see enough on the chart to think that. What you have to remember, stocks like Zoom and Peloton, these sort of COVID names. These were names that just, absolutely blew the lights out coming out of the COVID low in 2020 into 2021. And it was this, incredible dominance. This is the, sort of golden age of the ARK Innovation Fund. And there might be another golden age, but for now, that seemed to be it. And you saw those emerging technology names just ripping to the upside as we rethought everything about humanity during the those early COVID days, which seemed like a long time ago, only 3 years ago, 3.5 years ago. But if you look at what's happened for Zoom in the last 2 years, right? 2022, an absolute brutal year. And while the markets bottomed out in October and moved higher, a lot of stocks actually bottomed out in June. Zoom actually continued lower and has continued to push to the downside, making a new low in May, new 52-week low. Now, from there, it's stabilized a little bit. If we zoom into the last year, it's a little tough to chart this over the last 2 years because it's such a decline. So it makes all the recent data pretty compressed here. If you look here, this is kind of a range bound chart right over the last year. Really haven't gone anywhere. It's been a choppy kind of sideways environment. So, the problem I have with a chart like Zoom is there are other stocks and other sectors that just tend to do much better. There are MUSA and others that are breaking to new highs, energy stocks. There are Paramount Global and other media names breaking down in clear downtrends. This is one of those like in the middle names that isn't very good to the upside and it's not very compelling on the downside either. If there's a short-term play, I would say the fact that the RSI is right around 40. We're at a previous pullback level, so sort of in the 64, 66 range, clear support. We're holding that. Does that mean a short-term bounce? Maybe. Is this my favorite chart to take a shot at? No, it is not. So, again, but if you think about timeframes, I think it's important to be patient with a chart like this. We found resistance around 74, 75 a number of times. I'd love for us to get back above the 200-day moving average. I would very much like us to get above there and establish a higher low. And if this is a higher low that kind of goes from here, that could actually be pretty encouraging. I haven't seen enough to get excited about this yet. So in short, I think it will recover. Have I seen enough to think that that's happening today? Not yet. Next question. How do you calculate the real interest rate? And you had a number of comments, and you actually had a very detailed question talking about the Fed funds rate, short-term or long-term treasuries, what inflation data do you use? So let's take a step back, right? Interest rates, as we quote them, if we say the 10-year yield is at 4.7%, we are basically quoting the nominal rate, right? The listed rate, the rate that you would see as the official interest rate of a particular instrument is the nominal rate. Real rates are basically the nominal rate, but adjusted for inflation. So it's a pretty simple calculation, to be honest with you. You take the quoted rate, and so let's say the 10-year yield is at 4.7%, for example, and you take inflation. So let's say inflation is at 3.2%. So it's 4.7 minus 3.2, and the real rate would be the difference between the two, 1.5%. That's all you need to do. When you think about different, is there an official quote for the real rate? I think usually you have to clarify a little bit more what you're looking at. And any interest rate can have a nominal version and a real version. So when we talk about negative real interest rates, that was an issue that's come up recently in over the last decade, particularly in Europe, where you saw rates going down so much that the nominal rate was so low and inflation was big enough that real rates were lower. In the U.S., you can see examples of that, of course, as well. But it first became sort of magnified in Europe. All that means is basically you are getting a positive interest rate, but you're not getting much, not keeping pace with inflation. And the reason why you calculate a real interest rate is because the interest rate is basically what you're getting back for owning this thing, this bond or this loan or whatever it is. But the whole point of it is in some way you probably want to keep up with inflation. Otherwise, if your interest rate that you're getting your nominal rate and inflation are at the same point, then you're getting an income, but it's basically the same as inflation. So you're basically getting zero in actual dollars, right? So Some calculations we use, like real rates, like purchasing power parity, are all about recognizing how the value of the dollar, how the pace of inflation can affect how much your dollar is worth. So the calculation that you would use is basically use the main quoted CPI number. You want to look at an annual rate for both of those is probably the best thing to do, and that's going to help you get to a real interest rate. And again, that's why it's an important measure to use. The Fed funds rate really isn't a part of this. It's whatever bond or interest rate you're talking about versus inflation, the CPI data. Final question: how would you overcome bullish bias? And you mentioned you have a bullish bias. I don't know if I would describe what the bias you're saying as the bullish bias, but you're basically saying you have a tendency to jump in early, and you often feel like you're catching a falling knife. So you see things that are going down, you are really excited to buy, and as a result, you feel like you get in, too early, and so the price goes down. So I think the way that I would look at it, I'm just looking at the S&P in September and October as an example of a pretty clear market bottom. Right? We know now, looking back, that was a great bottoming pattern. So what told us that was a bottom? So here's what I would do. If you find that you're often buying too early, right? The market's going down, whatever price it is, it's going down, and you feel like you are getting in too early, and then the price keeps going down. I think what you have to remember, a couple things. First off, part of the technical toolkit, the technical library, are considered leading indicators. RSI is one of my favorite leading indicators. Things like, what else would be examples of this? You can consider like Fibonacci retracements. Elliott wave analysis as leading indicators because it's anticipating and looking for conditions leading up to a low that tells you the low is happening. The other, and much of the technical toolkit is more of a trend following technical toolkit, what I would describe as lagging indicators, things like moving averages, MACD, PPO, those sorts of things are really more lagging indicators. They're not meant to predict or anticipate a turn. It's more to confirm that a turn has already happened. So it sounds to me like you are approaching it with a lot of leading indicators, either explicitly or implicitly based on how you're looking at the chart. You see weakness as a really good reason to buy something, but you don't have enough of the lagging indicators, enough of a confirmation that the bottom is actually in. I think a lot of times, particularly investors that like to buy weakness, we get too excited about buying when something is very weak. And what you have to remember is price usually goes down for a reason, right? When the price is going down, it's not a fluke usually, right? Usually price is going down because people don't want to own that thing at the particular time. So you're basically betting on mean reversion. You're betting on everyone agreeing with you later, which can work, but it's really hard to do and pick out an inflection point real time. Leading indicators like on the S&P recognizing the bullish momentum divergence, super powerful, right? So lower lows in October, higher momentum. I wouldn't have a problem taking a position at a place like this because of that divergence, but with two things in mind. Number one, think about your position sizing. Could you take half of the position or a quarter of the position on the real bombed out, it's still going down kind of pattern, and then put the rest of the trade on once the price actually goes higher? Can you use moving averages, right? We break above a moving average. We break above, make a higher low. We break above resistance. All those things that were on my checklist from an earlier question. Did those sort of things, something in there kind of confirm, okay, now, not only did I have a leading indicator that told me a bottom might be coming, I actually have these confirmation tools that tell me that was the bottom. PPO, MACD is one of my favorite tools to do this. So could you use an RSI type of thing as a leading indicator, take half a position and then put the other half on when the MACD gives a buy signal? That might be a better way to do it. Because if the MACD never gives you a buy signal, then all you need to do is unwind the half a position. You limit your downside losses. You get some early benefits if you were amazingly right and bought at the lows. But if not, it's not going to crush your returns. I would maybe think of it a little more along those lines. And again, based on how you described your question, where you tend to buy falling knives, it sounds like you're using a lot of leading indicators, betting on contrarian moves. I get it, but I would say think about what you can do to confirm. So two things you can do about it is either wait for confirmation or just use stops to limit. And again, you'll just be wrong a lot, but just make it not too wrong when you're wrong, right? Limit your losses. And when you're right, just make sure you stick with those trends. That can actually be a pretty successful strategy. So it might be more about money management than anything else. Great questions, boy. We went all over the place. I feel like with those questions. I thank you guys so much as always for some really thoughtful questions. As a reminder, the mailbag is always open. Just shoot us a question via email. Best way to do it, thefinalbar@stockcharts.com. By the way, on our StockCharts platform, click on the permalink button below your Sharp charts, or if you're using our ACP platform, lower left, there's a little arrow to share the chart. That'll give you an HTML code, right? A web link. If you send me that link in the question, I can look at the live version of the chart that you're looking at as well. It makes it super easy to see what you're talking about. From StockCharts.com in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good one.